The situation and outlook for Australia's housing markets has again improved. The upturn that we saw around the start of the year has been sustained through the middle of the year. Clearly, the strengthening population growth, tightening rental markets and low on-market supply continuing to be important drivers there. In fact, when we look at the turnaround in population, it's those markets that have seen the biggest swing in net migration flows that are seeing the biggest turnaround in price growth, i.e. Sydney, Melbourne and other markets. It's less of a factor. In the case of Hobart, it's still seeing price declines with no migration turnaround. The other big thing though is that there's no longer the threat of additional rate rises. That momentum has been sustained despite some interest rate increases from the RBA, and we had thought that those followed by a couple of additional moves would see some faltering in this momentum we're seeing around prices. Now it looks more like the RBA is more confident about achieving its 2 to 3% inflation target by early 2025 and is unlikely to really drive a hard landing to achieve a midpoint of that target in the course of 2025. So we think policy rates have reached their peak, and that means we're not going to get another knock to the housing market from additional interest rate increases. We think that means the momentum sustains reasonably well this year. We think nationally prices will be up about 7% compared to our previous forecast of a flat result. For Sydney, it's looking like tracking towards a 10% gain for 2023 overall. That said, as we get into the back end of this year, we're going to see much clearer headwinds, particularly around affordability. By the end of this year, Sydney and Melbourne markets are going to see prices about 5% below their previous peaks. That's with interest rates 4 percentage points above their starting point when prices were already high. And that's clearly going to test the depth of demand, and we think that'll be a constraint emerging in the market that will restrain price growth throughout 2024 as well. Even with some rate cuts in the mix, we think price growth moderates to about 4% per annum nationally and moderates across those very stretched markets. We're already seeing some early signs of those constraints starting to re-emerge. So quite an unusual cycle, a price-led upturn rather than one led by a strengthening in demand, and it points to a more difficult or an unusual cycle more generally, even one once the RBA starts to cut rates. So of course there are some wildcards in this outlook. Near term we are starting to see some lift in seller activity, more on-market supply coming into the Sydney and Melbourne markets. That'll test the depth of demand over the next few months. Further out, the real question marks are around which way investors head at this point. The very tight rental market and improving rental yields will be a draw card and some renewed price growth. But at this stage, there looks to be a pretty low appetite from investors more generally. The other one that seems to be in the mix as well is, we've talked a lot in other parts of the economic outlook about this very high level of pandemic reserves across the household sector. 260 billion accumulated during the forced savings of the COVID lockdown period. It may be that some of those funds are now finding their way directly and indirectly into housing markets, and so it may be particularly the high income households that have the bulk of those reserves may be a bit of a wild card for which way this market heads in the next couple of years. But certainly the recovery, the upturn is looking more assured, and we look set for some continued price gains. That's a positive for some. It's going to be very challenging for the market more generally in terms of affordability.